Welcome to Unit 5, Session 4. We have been looking at capital gains tax and capital gains in the first three sessions of this unit. We now proceed to look at another form of the direct tax collected by the authority. This is the gift tax. So in this session, we will look at the meaning of gift, taxable gift, and imposition of tax on gifts. By the end of the session, you should be able to define gift and explain why gift is taxable, explain taxable gift, and outline the imposition of gift tax. Let us start by defining what a gift is. Gift is defined as something given willingly for no consideration or a transfer of property from one person to another without any compensation. So gifts can be in the form of tips, appreciations, end of service benefits, awards, etc. Now, gift tax is the taxation of gifts. According to our laws, when a person receives a gift in respect of their employment, business, investment, other than under a will or upon intestacy, or by way of transfer to the spouse, child, or parent of that person, any such gift is taxable. One may ask, if something is given free of charge, why then should it be taxed? The answer is that gift tax is an anti-avoidance scheme. Tax avoidance is simply using the loopholes in the tax laws to minimize or reduce one's tax liability. This is different from tax evasion. Evasion is using the illegal means to reduce your tax liability. So for tax avoidance, I know that farming businesses in Ghana enjoy industry concessions. During that period, you pay low tax or no tax at all. So in the case of farming tree crops, it enjoys concessionary period for 10 years. In the case of farming cattle, it is 10 years. And for livestock, fish or cash crop for 5 years. Remember, we treated this in Unit 1, Session 6. Okay, so if I want to avoid tax, I will enter into such operations. I will first farm cattle for 10 years and then switch to tree crops for another 10 years, then switch to livestock or fish for 5 years. So for 25 years, I will be paying tax at a lower rate or pay no tax at all. Now let us look at this in the context of gift tax. If gifts are not taxed, individuals and businesses will record most of their incomes under gift to avoid tax payment. So that is why we say gift tax is used as an anti-avoidance scheme. Let us look at some taxable gifts in Ghana. These include building of a permanent or temporary nature, land, shares, bonds and other securities, money including foreign currency, business and business assets, any means of transportation by land, air or sea. We have goods. Then we have part of or any right or interest in, to or over any of the assets referred above. So these are some gifts taxable in Ghana. We also have an asset or benefit where situated in Ghana or outside Ghana received by a resident person as a gift or for the benefit of that person. We also have a favor in money or money's worth or a consideration for an act, inures omission, or the forbearance of an act or omission that acts or inures for or to the benefit of a resident person. What this point is talking about is where the situation is talking about a situation where someone does something or refrains from doing something in exchange for some form of benefit from a resident person, and the result is that the resident person benefits from the action or inaction. This is taxable. Then we also have an asset, whether situated in Ghana or outside Ghana, received by or for the benefit of a resident person as a gift, where the asset has been or is credited in an account or has been or is invested, accumulated, capitalized, or otherwise dealt with in the same name or on behalf of or at the direction of that person. This is also taxable. Let us look at the imposition of gift tax. According to the Income Tax Amendment Act 2016, Act 924, gifts received in respect of employment or business or investment is added to employment income or business income or investment income and taxed accordingly using the appropriate tax rate. Individuals may elect to pay a 15% tax on gifts received instead of including the gift in employment or business income or investment income. And in the case of a non-resident, the gift is taxable at 25%. Let us now look at some gifts exempt from tax. If you receive a gift less than 50 Ghana cedis, it is exempt from tax. If you receive a gift under a will or upon intestacy, it's exempt from tax. If you receive a gift from spouse, child, parent, brother, sister, aunt, uncle, nephew, niece, it's exempt from tax. Gifts received by religious body which uses the gift for the benefit of the public or a section of the public. This is also exempt from tax. Then any gift for charitable or educational purposes. This is also exempt from tax. This brings us to the end of today's section. In today's section, we looked at the meaning of gift tax, imposition of gift tax, and gifts exempt from tax. Hope you enjoyed this session. Thank you.